Mutual funds versus fixed deposits. Where does money really grow? What if I told you that two people invest the same amount of money for the same time, but one ends up with almost double the wealth of the other? No scams, no shortcuts, just one smart decision. Today, we are exposing the real difference between mutual funds and fixed deposits and where your money actually grows. Mutual funds versus fixed deposits. This debate has been going on for decades. Banks promote fixed deposits as safe and reliable, while financial experts talk about mutual funds as powerful wealth creators. But which one truly helps you grow your money in the real world? Not in theory, not in advertisements, but in actual, long-term financial reality. In this video, we will break down everything in a simple, practical, and honest way. Risk, returns, inflation, compounding, liquidity, taxes, psychology, and real-life scenarios. By the end of this video, you will clearly know where your money really grows and which option suits you best. Understanding fixed deposits. Let's start with fixed deposits, also known as FDs. A fixed deposit is a financial product offered by banks and financial institutions where you deposit a fixed amount of money for a fixed period at a predetermined interest rate. At the end of the tenure, you receive your original money plus interest. Sounds safe, simple, and comforting. And yes, fixed deposits are designed for stability, not growth. Why people love fixed deposits? Predictable returns. When you invest $10,000 in a fixed deposit at a 6% annual interest rate, you already know exactly how much you will receive after 1 year. There are no surprises. Capital protection. Your principal amount is mostly protected. Banks rarely fail, and even if something goes wrong, insurance mechanisms often cover deposits up to a certain limit. Low emotional stress. There are no daily price fluctuations, no red or green screens, no panic. Fixed deposits let you sleep peacefully. Easy to understand. You don't need financial knowledge to invest in fixed deposits. Anyone can do it. The hidden truth about fixed deposits. Now comes the part most people ignore. Let's assume you invest $10,000 in a fixed deposit at 6% per year for 10 years. At the end of 10 years, your money grows to roughly $17,900. Sounds good, right? But here's the real question. Did your money actually grow? To answer that, we must talk about inflation. Inflation, the silent wealth killer. Inflation means the rise in the cost of living over time. What $10,000 can buy today will not be the same after 10 years. If inflation averages around 5% per year, the purchasing power of your money is quietly shrinking. So while your fixed deposit earns 6%, inflation eats away 5%. That leaves you with a real return of just 1%. In many years, inflation is even higher than FD interest rates. In such cases, your real return becomes zero or even negative. This means your money grows on paper, but in reality, your purchasing power stays almost the same. Fixed deposits protect money, but they rarely multiply money. Understanding mutual funds. Now let's talk about mutual funds. A mutual fund pools money from many investors and invests it in assets like stocks, bonds, or a mix of both. These funds are managed by professional fund managers. There are different types of mutual funds: equity mutual funds, debt mutual funds, hybrid mutual funds, index funds. Each type has a different risk and return profile. Why mutual funds exist? Mutual funds exist for one primary reason: to grow wealth over time. Instead of lending your money to a bank, you become a partial owner in businesses, governments, or large economic systems. When companies grow, your investment grows with them. How mutual funds create wealth. Let's take a simple example. You invest $10,000 in a well-diversified equity mutual fund that delivers an average annual return of 12% over 10 years. After 10 years, your investment becomes approximately $31,000. Now compare this with a fixed deposit value of around $17,900. The difference is not small, it is massive. And this difference exists because of compounding combined with growth assets. Power of compounding explained. Simply, compounding means earning returns not only on your original money, but also on the returns you already earned. In fixed deposits, compounding exists, but the rate is too low to create meaningful wealth. In mutual funds, higher long-term returns supercharge compounding. This is why time matters more than timing. The longer you stay invested, the more powerful compounding becomes. Risk, the most misunderstood word. Most people avoid mutual funds because of fear. They hear words like market crash, volatility, loss, and panic. Yes, mutual funds involve risk, but risk is not the enemy. Uninformed risk is the enemy. Fixed deposits have risk too. Inflation risk, reinvestment risk, low return risk. These risks don't look scary, but they slowly destroy wealth. Mutual fund risk over time. In the short term, markets are unpredictable. In the long term, markets reflect economic growth, innovation, and productivity. Historically, diversified equity mutual funds have delivered strong returns over long periods despite temporary crashes. Time reduces risk in mutual funds. Liquidity comparison. Fixed deposits lock your money. Breaking an FD before maturity often results in penalties and reduced interest. Mutual funds, especially open-ended funds, allow you to withdraw money anytime at current market value. This flexibility is extremely valuable in emergencies. Tax impact. The silent return killer. Taxes matter. Interest earned from fixed deposits is fully taxable as per your income slab. This reduces your effective return significantly. Mutual funds, depending on type and holding period, often enjoy better tax efficiency. Lower taxes mean higher real returns. Emotional discipline and investor behavior. The biggest risk in mutual funds is not the market. It is the investor. People panic during market falls and sell at the worst possible time. Successful mutual fund investing requires patience, discipline, and a long-term mindset. Fixed deposits require no emotional control, but also offer no financial excitement or growth. Who should choose fixed deposits? Fixed deposits are suitable for short-term goals, emergency funds, people who cannot tolerate any volatility, capital preservation needs. Fixed deposits are parking tools, not growth engines. Who should choose mutual funds? Mutual funds are ideal for long-term goals, wealth creation, retirement planning, beating inflation, financial independence. If you want your money to work for you, mutual funds are powerful tools. The smart strategy, combination of both. The smartest investors don't choose one, they use both. Fixed deposits for safety and stability, mutual funds for growth and wealth creation. Balance is the key. Final reality check. Fixed deposits make you feel safe. Mutual funds make you financially strong. Safety protects money, growth multiplies money. The real question is not which is better. The real question is, what does your financial goal require? Thank you for watching this video. Like, share, and subscribe to our Finance Reality channel for more interesting information videos.